A classic example of a growth company is Tesla. Tesla PE ratio right now is 1098. That basically means that the share price is 1000 times their earnings. And the reason for that is because, as you can see, Tesla reinvests most of their earnings into growth. So even though the revenue is growing immensely, substantially across the years, achieving over 30 billion in revenue, Tesla is now bigger than either Kraft Heinz or Mondelez International, which we just analyzed before. They still have earnings that are negative. That's incredible, isn't it? So if you look at, for instance, 2019, 24 billion of revenue was 800 million in profit loss. And then 2020 was the first year that Tesla actually made a profit of 720 million. So that basically means that P ratio is irrelevant for Tesla. But if we look at their financials, we're gonna see that a lot of things are actually relevant. In Tesla. Let's look at the net debt. So, for instance, you can see here that they have a net debt of 7 billion over a 52 billion assets company, or 30 billion revenue. Is not as bad as we previously compare against Mondelez and Kraft Heinz, but that doesn't tell you much about Tesla. So what should you be looking at when you're looking at a growth company? I think the growth company, the most important thing is who is leading it, because if you look at Amazon was on triple digits P ratios for a long time, but guess what? Jeff Bezos was leading it, and it grew and it grew and it grew. The other thing to look at is what's the size of the market. So there are a couple of things about Tesla. First, the electric vehicle market. Here, 3 million electric vehicles were sold in 2020. That's about 5% of new cars. That's a hell of a lot. However, it is projected to continue to rise and reach 48% by 2030. So that basically, obviously, you need to always cross-check your research. I'm just giving you a bit of an idea of what I would look for, but whoever is in the market would know a lot more than me. That's why Peter Lynch says that you should be investing in companies where you work in that kind of industry, because you know a lot more than outsiders. But he's already telling us that, in 10 years, that industry should grow by 40 percentage points because it's compounding interest. So it's more like 3 to 3.5 percentage points a year, which is a hell of a lot. So if Tesla currently have 30 billion in revenue, that basically can multiply by 10. That can multiply by 10 in 10 years just on the market of electric vehicles, and that 30 billion can then be 300 billion in revenue. The other thing is Tesla is the number one company emerging to take over the current establishment on batteries, because their batteries, the long lasting with the largest storage. So the size of the battery market currently is 108 billion. Tesla can outsource this, or it can manufacture this for other companies, can do a lot of side deals that can also tap into this 100 billion market. Then, last but not least, Tesla is also the number one in terms of data, has trillion bits of data on autonomous vehicle, whilst its largest competitor, Google, in this space, has so much less, has 1,000th less than Tesla in terms of data on autonomous driving of cars driving on their own. And this market size is projected to go to $888 billion by 2028. Obviously, those are all projections, but you can see why Tesla has the valuation it does, because of the market potential and because it's number one in many different industries in autonomous vehicles, in electric vehicles, in batteries, with the largest projection and opportunity for growth. So, what you would do here is basically look at the market share that Tesla have in electric vehicles, multiply by the market cap of the industry, and then add to the other industries that is capable of poaching. And then finally, you would try to understand how much is reasonable for Tesla to grow year after year. So I'm going to work on this template and then we are going to analyze it together. So here's an example of how you would look at a growth investing opportunity. So here's Tesla as of April 2021. So the market cap of the company is 663 million that you can calculate by the share price times the times of shares that are at the public disposal, or you can just go to Yahoo Finance. Okay. So that brings us to the P ratio of 1075. That basically means that 1075 times their earnings in billions, that gives the market share, equals to the market share. The revenues is 31.5 billions. So their earnings revenue, so earnings divided by revenue, is a percentage profit margin of the business is about 2.2%. So basically, what this PE ratio is telling us is that for a PE ratio to be at around normal levels that you would expect, which is about, 10, 20, 30, whatever it is, the other vehicles of 2020. So that basically means that estimated earnings needs to reach 70 billion for that PE ratio to be 10.7. So there is already one fallacy, right? That actually maybe in 2030 Tesla will still be a growth stock and the PE ratio will still be expected to be 100, 50, 20. You don't know that. That's one assumption that you need to take. Please don't take this example for granted. Do your own research. This is just an example of how we would look at a growth stock. Then, for us to achieve that kind of earnings, what revenue do we expect? Because remember, currently only 2% of the total revenue becomes earnings. So that would be a $3.5 trillion revenue. But you need to be optimistic about it because that's a fairly new company. They don't even have 20 years as yet, or maybe they are turning 20 years. So there is a lot of opportunity to cut costs in the future. So let's say that they become more efficient by 10 times. So that earnings revenue, instead of being 2%, will be 20%. So what does that mean? That means that actually, instead of needing a 3.5 trillion in revenue, they will need a 350 billion in revenue. Okay, let's look at the three main markets that Tesla will operate. So currently they're operating primarily in electric vehicles market in 2020. That's the number in terms of value of electric vehicles sold in 2020. Tesla has a global market share of 28%. That basically brings us to the revenue that they currently have. But let's say that we go with the current projections of electric vehicle market, and by 2030 there will be 10 times more. So 1.2 trillion market, which if market share remains constant, Tesla will have a global market share of 336 billion in revenue. But if they manage to grow their market share to their US market share, but globally, that would bring them to 960 billion in revenue. Here's, for instance, in 2019, their newest competitors, mainly Chinese, Bike and BYD, but they've also got Mitsubishi, BMW, Toyota. There are a lot of competitors, Volkswagen. So this is a big question mark for us to see. The autonomous vehicle market is expected to be around 880 billion market, but you got to see those numbers and then already ask the question in your mind, okay, so aren't they interconnected? Probably yes, because all of the vehicles then will probably be autonomous, um, or have the possibility of being autonomous. So I'm not taking this too much into consideration. The battery market is around $110 billion. That battery market is still growing. It will probably be our current projections 130 billion. If Tesla managed to acquire 28% of the market, that would be 36.4 billion for Tesla in terms of revenue, and 104 billion if managed to acquire 80% of the market. So as you can see now, with the market share constant and by achieving that market share in the battery market as well, Tesla would have a revenue by 2030 of $372 billion, which is more or less already the estimated revenue of the current valuation of the company. So basically, it's already booked in. All of that projection is already booked in into the price. However, if Tesla managed to grow their market share even further, and if people will still think that Tesla will continue growing, therefore justify a higher P ratio, then Tesla will still grow further. Then the next thing that you would look at is, okay, in those 10 years, Tesla could maintain itself flat by just not inputting any other valuation in its price, or it could think that it could achieve the 80% global market share everywhere. So, what would you do in this case? Okay, the next step here is just to try to identify how much can Tesla grow in terms of revenues even further and compare that against the growth in interest rates, because that's the value of your money applied elsewhere. And that you have a very simple growth stock analysis. Obviously, if you're gonna buy this stock, you're gonna go a lot further with a lot more research to go behind these numbers and tell what the truth is, because those are just projections at the moment. But the more you dig in, the more information you're going to find it, and then it will make more sense. Just want to give you a glimpse of how analyzing a growth stock is a lot more different than a value stock. I hope you like this.